10 Investment Strategies for Long-Term Wealth. Building long-term wealth requires more than luck. It demands consistency, patience, and a well-thought-out investment strategy. Whether you're a beginner or a seasoned investor, understanding how to grow and protect your money over decades is the key to achieving financial independence. Before we get started, subscribe to our channel and turn on the notification bell so you never miss our latest content. 1. Embrace the power of compounding. The foundation of long-term wealth is the power of compounding, earning interest on both your original investment and the accumulated returns. When you reinvest your earnings, your money begins to grow exponentially over time. For example, investing $10,000 at a 7% annual return can turn into over $76,000 in 30 years without adding more capital. The earlier you start, the more compounding works in your favor. Even modest investments can grow into substantial wealth if given enough time. Compounding rewards patience, consistency, and discipline, making it one of the most powerful forces in finance. Start investing early and reinvest your returns. Even small, regular investments can multiply significantly due to compounding. Avoid withdrawing earnings prematurely. Time is your greatest ally in building exponential wealth. 2. Diversify across asset classes. Diversification is about not putting all your eggs in one basket. A smart investor spreads risk across multiple asset classes such as stocks, bonds, real estate, and commodities. This approach helps reduce losses during market downturns since different assets often react differently to economic changes. For example, when stock markets fall, bonds or gold might rise, balancing your portfolio. A diversified portfolio ensures you're protected from volatility while maintaining steady growth over time. Diversification doesn't eliminate risk, but it minimizes the impact of bad market cycles on your overall wealth. Allocate investments across various assets to manage risk. Include domestic and international stocks, bonds, and real assets. The goal isn't to avoid loss entirely but to balance risk and reward for smoother long-term growth. 3. Invest in index funds and ETFs. Index funds and exchange-traded funds, ETFs, have become the go-to investment vehicles for long-term investors. They track major market indices like the S&P 500, providing instant diversification at a low cost. Unlike actively managed funds, index funds have minimal fees, which can make a huge difference in returns over time. These funds are designed for long-term performance, reflecting the market's upward trajectory. With consistent contributions and reinvested dividends, index investing can outperform most active investors who try to time the market. Index funds and ETFs offer low fees, diversification, and consistent market returns. By investing regularly and holding long-term, you can benefit from overall market growth without the stress of stock picking. 4. Prioritize dividend-paying stocks. Dividend-paying stocks provide both steady income and potential for capital appreciation. Companies that pay regular dividends often have strong financial foundations and a history of stable performance. Reinvesting those dividends into more shares accelerates compounding and long-term growth. Dividend yields can act as a buffer during market downturns, offering a steady cash flow when prices fluctuate. Over time, dividend stocks can generate consistent returns and provide financial security, especially in retirement. Focus on quality dividend-paying companies with stable histories. Reinvest dividends to enhance compounding and long-term income growth. Dividend stocks are ideal for building a passive income stream while accumulating wealth. 5. Take advantage of tax-advantaged accounts. Using tax-advantaged investment accounts can significantly boost your long-term returns. Retirement accounts like 401ks, IRAs, or Roth IRAs offer tax benefits that allow your investments to grow faster. Contributions may be tax-deductible, or withdrawals may be tax-free, depending on the account type. Over decades, avoiding taxes on growth can result in much larger balances. Investors who maximize their contributions every year gain not only compounding benefits but also reduced tax liabilities, one of the smartest ways to preserve and build wealth. 6. Focus on long-term value investing. Value investing involves identifying undervalued companies with strong fundamentals and holding them until the market recognizes their true worth. This strategy requires patience and research but often yields superior long-term results. Investors like Warren Buffett have built immense wealth by buying quality businesses at reasonable prices and letting them grow over decades. The goal is to own companies with competitive advantages, solid earnings, and reliable management rather than chasing short-term hype or trends. 7. Invest in real estate for passive growth. Real estate is a powerful tool for long-term wealth creation. Whether through rental properties, REITs, or real estate crowdfunding, property investments can generate consistent income while appreciating in value. Real estate provides tangible assets, hedges against inflation, and can offer leverage through financing. Moreover, rental income creates cash flow that can be reinvested into other ventures. Successful investors treat real estate as a long-term commitment, focusing on high-demand areas and managing properties strategically for sustained returns. 8. Automate and stay consistent. One of the most underrated strategies is automation. Automating your investments, through automatic transfers or recurring contributions, ensures you invest regularly, regardless of market conditions. This approach promotes dollar-cost averaging, where you buy more shares when prices are low and fewer when high, reducing overall risk. Staying consistent eliminates emotional decision-making and fosters long-term discipline. Over years, automated investing transforms small, routine contributions into substantial wealth without constant oversight. 9. Rebalance your portfolio. As markets shift, your asset allocation can drift from your original strategy. Periodic rebalancing, typically once or twice a year, realigns your investments to maintain your risk tolerance and goals. For instance, if stocks outperform and take up too much of your portfolio, selling some and reinvesting in bonds restores balance. This disciplined approach ensures you're not overexposed to market volatility and keeps your investments aligned with long-term objectives. Rebalancing enforces the habit of buying low and selling high, automatically enhancing returns. 10. Keep a long-term mindset. The most critical investment strategy isn't technical, it's psychological. A long-term mindset helps you stay calm through market downturns and resist emotional reactions. Successful investors understand that markets fluctuate but generally rise over time. Avoid panic selling during corrections and don't chase quick profits. Wealth grows with patience, not impulsiveness. Focus on consistent contributions, quality assets, and your long-term goals. Remember, time in the market always beats timing the market. If you enjoyed this video, give it a thumbs up and subscribe for more content. Hit the notification bell to stay updated with our latest videos. Share your thoughts in the comments below. Thank you for watching.